Welcome to the deep dive. Today, we're really digging into something huge, a major life decision for so many Canadians, buying that first home.
Yeah, it's high stakes, often stressful.
Exactly. And it's not just about the price tag anymore. We're seeing strategic patience, real financial juggling, and actually a surprising amount of clarity from buyers on what they want.
Hmm.
We've pulled together data from Q2 2025 that gives us a pretty sharp snapshot of their intentions, what's motivating them, and, the money side of things.
Right.
And the backdrop here is a market that seems to be, well, stabilizing. Prices aren't soaring like they were. Interest rates look like they're easing a bit.
But here's the interesting thing, the paradox, really. We see first-time buyers, they know exactly what they're looking for. I mean, their preferences are super clear, type of house, condition, all that.
Yeah, very specific.
Very specific. Yet even with market conditions looking, arguably better than a year ago, most are still waiting, holding back.
Okay, so that's our mission today then. Let's unpack that delay. Why the wait? And what kind of trade-offs, financial and lifestyle, are people making while they're on the sidelines?
Yeah, is this strategy
Mm-hmm.
or is this something else? And what happens when this big group does decide to jump in?
Good question. Let's start with just the sheer number of people thinking about this. The data shows about 13% of Canadian adults are planning to buy their first place in the next 2 years.
That's a significant chunk of the population, a huge potential wave of buyers.
It really is. But here's where it gets really interesting, I think. When you look at when they plan to buy,
Mhm.
an overwhelming 82% of that group, they're aiming for the longer timeline, like 12 to 24 months out, not the next year.
Wow, 82%.
Yeah. So they're researching, they're planning definitely, but
Mhm.
they're not exactly rushing out the door.
Okay, so that 82%, that really tells the story right now. And the why behind it, well, it seems pretty clear they're playing a waiting game, strategically.
How so?
They're essentially betting on interest rates. They see rates might trend lower, maybe further cuts are coming. So they figure, why lock in now if waiting a bit longer could mean a lower monthly payment?
So it's about potential future savings versus locking something in now when prices seem stable.
Exactly. They see prices have kind of plateaued, maybe even dipped slightly in some areas.
Yeah.
So the risk of prices running away from them feels lower right now. They're hoping for that sweet spot, stable prices and lower rates.
But isn't that a bit of a gamble? I mean, if everyone, or 82% of potential buyers, are all waiting for the same thing, what happens when they all decide to jump in around the same time?
That's the risk. Absolutely. You could create this sudden surge in demand right when they think conditions are perfect.
Which could just push prices up again, especially in the more affordable segments they're targeting.
Precisely. They're trying to time the market on rates, which is, notoriously difficult. If those rate cuts don't materialize as expected or if they're smaller than hoped,
Then they've waited for potentially nothing, maybe even lost ground if prices did creep up slightly.
right, or they all rush in together and create the very price pressure they were trying to avoid. So, yeah, the patience they're showing now carries its own risk down the road.
Okay, let's look at the current market that's making this wait seem feasible. Q2 2025 data. The national aggregate price hit $826,400. But year over year, that's only up 0.3%, basically flat.
Negligible increase.
And even quarter over quarter, prices actually dipped slightly, down 0.4%. So that really backs up the idea of stabilization, doesn't it?
It absolutely does. That lack of strong upward pressure is key. It gives buyers the confidence, or maybe the perceived safety, to wait. In the past, waiting often meant prices just kept climbing out of reach.
Right.
Today, waiting feels like it might actually lead to a better deal, mainly on the financing side. And we see this mixed picture reflected in what agents are reporting too.
What are they saying?
Well, about 36% said they saw more first-time buyer activity. But then 25% said things were pretty much unchanged.
So not exactly a floodgate opening, more like a slow trickle, very cautious.
Exactly. A cautious crawl, not a stampede.
Okay, so while they're waiting, strategically or not, they're definitely honing in on what they want. Let's pivot to that. What are these future buyers actually looking for?
Yeah, what's the dream home profile?
Well, get this. The classic detached dream is still incredibly strong. Almost half, 49%, prefer a single-family detached house.
Wow, even with the affordability crunch. That's persistent.
It really is. Despite knowing detached homes are generally the priciest option, that desire for space, maybe a yard, it's not fading easily.
And that preference forces other priorities, right? Like what else is crucial beyond just the type of house?
Well, the number one non-price factor, according to the data, is finding a home that's move-in ready.
Ah, that's a huge indicator. Move-in ready. That tells you a lot about their financial situation, doesn't it?
How so?
Well, think about it. If you've stretched absolutely everything you have just to scrape together the down payment,
Right.
you likely have zero extra cash or maybe zero appetite for the risk of taking on immediate repairs or renovations. You need cost certainty from day one. No surprises.
That makes total sense. The down payment hurdle is so high. The idea of needing another, say, $20 K for a new roof right after moving in is just not feasible for many.
Exactly. Predictability is key.
And we also see this interesting trade-off happening between lifestyle and location. 42%, quite a few, say they'll pick a neighborhood based on lifestyle factors. Could be parks, schools, vibe, even if it means a much longer commute.
That's a really significant choice. They're basically trading their time, potentially hours a day, for a certain type of neighborhood or house.
Yeah, valuing the where over the how long it takes to get to work.
And maybe, with more hybrid work setups, they feel they can handle a longer commute if it's only 2 or 3 times a week.
That's a good point. It could be a gamble on future work flexibility remaining the same.
It could be. Because if that changes, suddenly that hour-plus commute 5 days a week becomes a massive drain, not just time, but gas, car wear and tear. Adds financial stress right back into the equation.
True. And other top priorities kind of fit this pattern too. People want outdoor space. They want to be near amenities. So space and convenience are high on the list.
Which often pushes them further out, hence the commute trade-off, especially if they still want that detached home.
Right. It's all connected.
And look, the gap between dreaming and doing is pretty clear in their actual actions right now. Over half are researching neighborhoods, almost half are browsing online listings. The research phase is very active.
Okay, so lots of looking.
Lots of looking, but actual boots-on-the-ground activity, much lower.
Yeah.
Only about 19% has started going to open houses or showings.
Yeah.
And the same number, 19%, have actually contacted a real estate agent.
So much more learning and watching than active buying.
Precisely. They're deep in the information gathering stage, but maybe still figuring out that financial piece to make the dream actually happen.
Yeah. Which is the perfect segue. Let's talk about the money. If they know what they want, and it's often the pricier option, how are they planning to pay for it?
Yeah, the financial reality check. The first big hurdle is obviously the down payment. And the data shows a really interesting split here.
Okay.
A slight majority, 53%, say they're planning to put down 20% or more. That's the traditional goal, right? Avoid certain extra costs.
Right. But that leaves a big chunk who aren't.
A very big chunk. 39% plan to put down less than 20%.
Okay, maybe we should quickly clarify that for listeners. Why is 20% sort of the magic number? What's the deal if you have less?
Sure. So that 20% down payment mark is critical because it's the threshold for needing mortgage default insurance. In Canada, you often hear it called CMHC insurance, though there are private insurers too.
Right.
If your down payment is less than 20% of the home's purchase price, you have to get this insurance. And importantly, it protects the lender if you default, not you, the borrower.
And it's not free.
Oh, definitely not. The premium, which can be, somewhere between 2.8% and 4% of the amount you borrowed, usually gets added right onto your mortgage principal.
So you end up borrowing more and paying interest on that insurance premium for the life of the mortgage. Adds up to thousands, potentially tens of thousands extra.
Exactly. So that 53% aiming for 20% or more, they're making a conscious effort, often a huge effort, to avoid that significant added cost. They know it makes the mortgage more manageable long term.
Which means serious saving strategies must be in play.
Absolutely. And the data shows what they're doing. It involves some tough choices. 60% are looking for properties in cheaper areas.
Okay, that links back to the commute trade-off we talked about.
Yeah.
Trading location for affordability.
Precisely. Then you have 40% who are actively downsizing their expectations, maybe settling for a smaller place or fewer bedrooms than they initially wanted.
Right. Adjusting the dream.
And almost the same number, 39%, are cutting back hard on discretionary spending. We're talking vacations, eating out, entertainment, serious sustained lifestyle cuts.
Budgeting rigorously for years, potentially.
Years, yeah. And maybe the most telling sign of the financial stretch. Nearly 30% are planning to use retirement or investment savings, things like RRSPs through the homebuyers plan or TFSAs.
Wow. Dipping into long-term savings meant for retirement just to get into the housing market now?
It really speaks volumes, doesn't it? It's not just delaying fun stuff. It's potentially compromising future financial security for homeownership today. It shows how intense the pressure is.
Okay, so if personal savings are stretched to the absolute limit, even raiding retirement funds, that brings us to outside help. And this is where the data reveals something pretty stark about affordability today.
Yeah, the reliance on external financial support, it's significant.
Get this. 41% of these prospective first-time buyers say they expect to receive financial help from family or friends.
41%. Let that sink in. Almost half.
Meanwhile, 51% say they won't get that kind of help. It really highlights a massive divide, doesn't it? For nearly half the market, getting that first home isn't just about their own earnings and savings anymore.
It's absolutely critical. That 41%. For many of them, that family help is the bridge. It might be what gets them to that 20% down payment threshold, or helps them avoid the highest insurance premiums, or maybe just makes the purchase possible at all.
So entry into the market is increasingly tied to, well, having family who can help, intergenerational wealth.
That's exactly what it points to. Their ability to buy is linked to their family's financial capacity.
And when we look closer at the kind of help they're getting, it's not always just a straightforward gift. The data breaks it down.
Right. There are different ways this support happens.
Can you walk us through that? Like, what's the difference for the buyer, and maybe the family too, between getting a loan versus having a cosigner?
Sure. They're quite different. So among those getting help, about 27% said they're receiving it as a loan.
Meaning they have to pay it back.
Correct. It's still debt for the buyer, though probably with, much better terms than a bank loan. But compare that to the 28% who are getting a cosigner.
What does that involve?
A cosigner is someone, usually a parent, who signs onto the mortgage with the buyer. They are legally on the hook for the entire mortgage debt if the buyer can't make the payments.
The bank goes after the cosigner.
Immediately. Their own credit is impacted. Their assets could be at risk. It's a much, much bigger commitment and risk for the family member providing the help.
Okay. So loan means repayment obligation for the buyer. Cosigner means direct liability for the family member. What else?
Well, there's the outright gift. 29% expect a lump sum with no repayment needed. That's the classic bank of mom and dad gift.
Right.
But interestingly, 26% expect help covering the monthly payments.
Oh, wow. So not just help getting in the door, but ongoing help staying there.
Exactly. It's not a one-time boost. It's potentially years of financial linkage and reliance between the buyer and their family just to manage the carrying costs. It really underlines that the affordability challenge extends well beyond just the down payment.
That's profound. It really paints a picture of a market splitting in two. You have one group managing through intense personal sacrifice and saving, and another, almost equally large group, whose ability to participate at all hinges entirely on whether their family has the resources and the willingness to step in.
It's a stark reality of the current market. So if we boil it all down for you listening, the key things we're seeing are, number one, high intent to buy, but most are playing a calculated waiting game, hoping for lower interest rates, even with the risk that involves.
Okay, wait and hope.
Number two, the dream home is still, for many, that detached, move-in ready property, even if it means making big compromises elsewhere, like accepting a really long commute.
Right, lifestyle trade-offs.
And number three, getting the finances together is incredibly tough. It involves deep saving strategies, sometimes using retirement funds, and for almost half the market, relying heavily on various forms of family financial support. The barriers are significant.
So putting it all together, what we have is a group of buyers who are really informed, they're strategic, they're being incredibly patient, but at the same time, they're making these huge lifestyle bets, banking on work flexibility, draining future savings just to reach the goal.
They're dedicated, no doubt, but the path demands some pretty extreme financial maneuvering.
It really does.
And maybe we can leave you with this thought to mull over. If close to half of all first-time buyers now need financial help from family gifts, loans, cosigners, payment helper, what does that tell us about what market accessibility even means today? Is homeownership becoming less about personal achievement and more about inherited advantage? And what could that mean long-term for wealth distribution across Canada? Something to think about.